Today, the inflation battle is causing casualties. Well, again, it's Martin North from Digital Finance Analytics, World Latest Posts covering finance and problem news with a distinctively Australian flavour. Today, we're going to look at the fallout from the RBA's rate announcement yesterday, consider what's going on in the US with regard to bonds ahead of the Federal Reserve decision later in the week, look at what happened in the UK when the ECB started its quantitative tightening program, and then go across to New Zealand to look latest on home prices and also what the bank over there is thinking about the future. But we'll start with the RBA's rate announcement yesterday. That was the first on a Melbourne Cup date since 2010. NAB was the first lender out of the gate to announce a variable rate rise of 0.25% from the 11th of November. Presumably the others will follow in due course. Now, of course, these rate rises have real-life consequences. That decision to increase the cash rate by 0.25% in November will add an extra $79 to repayments for a typical $500,000 loan over 30 years, or $158 a month for those with $1 million worth of debt. Rising interest rates and falling house prices will also lock some borrowers into a mortgage prison, with limited ability to lower their borrowing costs through refinancing. I'm going to have a lot more to say about that in future shows. In fact, the Governor spoke in Hobart last night after the board meeting and reiterated that inflation will be higher for longer, unemployment will rise, and that there was a narrow path to avoid a recession. Defending the RBA's seventh straight rate rise, Dr. Lowe said high inflation was a scourge that needed to be dealt with swiftly to stop people becoming accustomed to high price increases, making a bad situation worse. If this were to happen, the evil of inflation would be with us for longer, and the eventual increase in interest rates needed to bring it down would be greater, he said. This would increase the risk of a severe recession and a sharp rise in unemployment. It would be much better to avoid such a costly outcome, and so we've acted strongly to avoid it, he said. And in his most pointed remarks to date, the central bank governor said high inflation worsens inequality and it undermines living standards. It hurts us all by impairing the functioning of our economy. It is for these reasons that the Reserve Bank Board will make sure that this episode of high inflation is only temporary, he said. And he said, to control inflation, the board has already increased interest rates substantially. They moved in large half percentage point increments for 4 months, but at this and the previous meeting, they returned to more standard quarter percentage point increases. The earlier larger increases were required to move interest rates quickly away from their pandemic levels to address the rapidly emerging inflation problem. But as interest rates moved back to more normal levels, the board judged that it was appropriate to move at a slower pace while they assess the data, the economic outlook, and the impact of the rate rises to date. They are conscious, he said, that interest rates have been increased by a large amount in a very short period of time, and that higher interest rates affect the economy with a lag. If we are to stay on that narrow path, he said, we need to strike the right balance between doing too much and too little. The board's base case, he said, remains that interest rates will need to go higher still to bring inflation back to target, and their forecasts have been prepared on that basis. But, he said, we're not on a preset path. If we need to step up to larger increases again to secure the return of inflation to target, we will do that. Similarly, if the situation requires the bank to hold steady for a while, we will do that too. Given the uncertainties regarding the outlook, he said, we'll be watching very carefully how the economy and the inflation pressures evolve over the summer. Now, over in the US, bond markets there rallied amid fresh warnings that a recession is inevitable as the US Central Bank convenes for a 2-day meeting expected to result in a 5th straight outsized rate hike. The yield on the 10-year Treasury fell as much as 12 basis points to 3.93%, compared to a peak of 4.34% last month. That's the highest since 2007. German 10-year yields, though, fell 10 basis points to 2.04%. And 2-year US yields, which are more sensitive to imminent Fed moves, topped 4.5% after sliding as much as 8 basis points earlier in the day. The rush for bonds comes as Chair Jerome Powell's favoured portion of the yield curve, that's the difference between where the 3-month rates are now versus where they're expected to be in 18 months' time, is on the cusp of inverting, with the spread between the two tumbling to less than 0.2 percentage points on Tuesday from 2.7 percentage points back in April. An inverted yield curve, of course, is a key warning sign for many investors that a recession is coming as the market begins to price in an end to tighter policy and braces for lower rates in the future to soften the blow of a looming slowdown. Many closely watched spreads in the Treasury market have actually already flipped below zero. Policy rates are entering restrictive levels, while there have been some soft patches of economic data of late, said Francis Chung, a Singapore-based rate strategist at Overseas Chinese Banking Corporation. At some point, the Fed needs to move to smaller rate hikes, and this may happen at the December FOMC meeting. Back in March, Powell downplayed the significance of the 2-year yield raising above 10-year rates. That's an often cited harbinger of recession. He argued traders were looking at the wrong metric and that the shorter end measure gives a clearer read. Because if it's inverted, that means the Fed's going to cut, which means the economy is weak. Global markets have been disturbed this year by an increasingly hawkish Fed arguing that it needs to quash sky-high inflation, even as the risk of a so-called hard landing for the economy grows. Its conundrum looks to be intensifying as robust inflation and labour market data contrast with signs of weakness in other parts of the US economy. That debate is also being reflected by the Fed pricing. Money markets have fully priced in a 75 basis point increase this week, but bets on yet another jumbo hike in December are wavering and are significantly lower than they were back in October. Another widely followed yield curve, the gap between the 3-month and 10-year treasuries, inverted last week for the first time since March 2020. And US stocks finished lower as data showed a solid US labour market, and that bolsters speculation that Federal Reserve policy would remain aggressively tight even with the threat of a recession. At a time when good news is considered bad news when it comes to policy conjectures, the S&P 500 wiped out a rally as the figures highlighted an unexpected rebound in US job openings, which may keep the pressure on the Fed. It was the 26th time in 2022 that the equity gauge erased a gain or loss of at least 1% in one session. That's the most for any year since the financial crisis. Big tech weighed on equities, with Apple down almost 2% and Amazon's value ending below $1 trillion for the first time since 2020. After the close, Advanced Micro Devices topped earnings estimates and signaled that inroads in the lucrative server chip market will continue to bolster its finances. The Dow Jones Industrial Average traded near a resistance level that saw the index halt a few rally attempts in the past few months, and hopes for a Fed dovish pivot are misplaced if today's job openings are any guide, said Ronald Temple, head of US equity at Lazard Asset Management. Despite some signs of economic acceleration elsewhere, the job openings data, taken together with non-farm payroll growth, indicates the Fed is far from the point where it can declare victory over inflation and lift its foot off the economic brake. And it's interesting that Friday's job report is currently forecast to show US employers added around 196,000 workers to payrolls in October. Economists are expecting the unemployment rate to edge up to 3.6% and for average hourly earnings to post another solid advance. Former Treasury Secretary Larry Summers said in a tweet that the growing chorus for the Fed to pause interest rate hikes very soon is, quote, badly misguided. He added that this is consensus of economists who have a track record since COVID of being dismally wrong on inflation. And he also noted that the Fed should stay on the current course and then evaluate things. To Matt Maley at Miller, Talbot & Co., a lot of what will take place in markets over the next few months will hinge upon Powell's signals on Wednesday, as well as the subsequent Fed speak. Tom Porcelli at RBC Capital Markets says that if the Fed's boss really wants to transition to shallow hikes, he should maintain some element of hawkishness, as there's a decent risk of creating confusion. As we've not yet reached the peak for Fed rate hikes, it's highly unlikely that we've already seen the bottom of this bear market, especially given the history of Fed rate hikes peaking before the market troughs, noted Seema Shah, the chief global strategist at Principal Asset Management. She anticipates the market floor for this cycle will most likely be reached at the end of the first or second quarters of 2023. For now, Shah sees both market and inflation volatility persisting alongside further Fed rate hikes in the last few months of 2022 and into early next year. Lauren Goodwin of New York Life Investment said she believes the Fed may pause its rate hikes soon, even amid strong inflation, though. Financial conditions have tightened substantially and recession should be considered a base case. She added, "Let me be clear, a Fed pause is not the same as a pivot," Goodwin added. Certainly, deteriorating economic and credit conditions would cause the Fed to pivot modestly at some point, but a full pivot into accommodative territory is highly unlikely in the next year. Also weighing on market sentiment was a report showing US manufacturing neared stagnation in October as orders contracted for the fourth time in 5 months, while an index of prices paid fell to a more than 2-year low. The figures added to evidence of recession concerns as central banks step up the fight to get inflation under control. And earlier in the day, speculation that China is preparing to gradually exit the stringent COVID-0 stance helped boost equities. A gauge of the nation's stocks listed in Hong Kong surged almost 7% intraday, but shares paired gains after a Chinese Foreign Ministry spokesman said he's not aware of any committee on ending the policy. Now, over in the UK, the Bank of England passed a major milestone on Tuesday when it held its first auction to sell some of the £875 billion of government bonds that it bought during successive quantitative easing, or QE, programmes from 2009 to 2021. Britain's central bank is actually the first in the group of 7 rich nations to actively sell QE bonds to investors. The US Federal Reserve and the Bank of Canada have adopted similar policies, sometimes known as passive quantitative tightening, to help shed bonds accumulated during years of stimulus to support crisis-hit economies. So the Bank of England sold £750 million worth of bonds on Tuesday, and the central bank said it received $2.44 billion of bids for the various short maturity gilts that it put up for sale. That's a bid to cover ratio 3.26. The bonds are from the Bank of England's asset purchase facility, which accumulated close to £900 billion worth of government debt at its peak last December. The move is aimed at reversing the QE programme that helped prop up the economy through the global crisis and the pandemic. Under the programme, the Bank of England bought bonds in financial markets to push interest rates to near zero, hoping that easier money would give investors confidence and help foster growth. So while QE kept a lid on market interest rates, Governor Andrew Bailey hopes that its reverse, dubbed quantitative tightening, can run in the background and leave the focus on the Bank of England's benchmark lending rates as the main tool of managing monetary policy. So far, that's working. Gilts extended gains later in the afternoon as traders paired bets on future rate hikes, pricing interest rates to peak at around 4.75% next year. The UK 5-year yield last traded at 3.48%. That's down 13 basis points. With short maturity bonds holding up well versus their long-term peers, the sales do not appear to have experienced many hiccups, said Pooja Kumar, a rate strategist at Toronto Dominion Bank. The Bank of England started paring back its government bond holdings in February when it agreed to allow maturing debt to roll off the balance sheet instead of being replaced. While the US Federal Reserve is doing the same, it hasn't pursued active sales yet. The experiment comes at a delicate moment for the Treasury and the Bank of England. Once the Bank of England's planned sales are added to the government's financing needs, investors will have to absorb the largest supply of UK bonds in history, according to the nation's debt chief. What's more, only weeks ago, the central bank was buying bonds under its financial stability mandate to tame a disorderly sell-off, with those securities held in a separate portfolio from its main gilt fund. The impacts of that chaos still lingers, with the Bank of England excluding longer maturities from its active QT plans, at least for now. The risk that the Bank of England faces is that QT is beginning at a time when there is going to be an increase in supply given the fiscal measures that have been announced already, Imogen Baccarat, head of UK rate strategy at NatWest Markets, said. The Bank of England's £750 million worth of sales on Tuesday will wipe a larger amount off its balance sheet. This is due to the difference between the nominal value of the bonds and the price at which the Bank of England sold them. Selling at a lower price crystallises losses for the government, which is financially responsible for the portfolio. The loss to the Treasury on Tuesday's auction alone will be around £90 million. The Bank of England is hoping to reduce its holdings by around £80 billion in the next year. That would include about £35 billion of redemptions, leaving around £45 billion of reductions via sales. At current prices, that will mean active sales of less than £40 billion, with the government making up the rest of the shortfall. The Bank of England's decisions to actively sell its gilt holdings contrast to the European Central Bank's approach, widely expected to be done on a passive basis, and which is not expected to start until 2023 at the earliest, to avoid roiling fragile markets. But Tuesday's outcomes show that active sales can be achieved with minimal disruption. That's what the Bank of England wants. It should be like watching paint dry, said Hank Calenti, fixed income strategist at SMBC Nikko Capital Markets. It's worth just noting that a start to the sales process was delayed first by the postponement of September's Monetary Policy Committee meeting after the death of Queen Elizabeth, and later by a chaotic sell-off in gilts triggered by the then Prime Minister Liz Truss's plans for unfunded tax cuts. The market turmoil forced the Bank of England to intervene and buy £19 billion worth of long-dated and inflation-linked gilts in an emergency programme that ran until October the 14th. The Bank of England will now hold 8 gilt auctions this year, totalling £6 billion of sales and including gilts with a maturity of up to 20 years. It had originally aimed to sell £8.7 billion worth of gilts this year, including some with a maturity of over 20 years, the type that were hit the hardest by that fire sale of assets from pension funds following the Truss government's September 23rd mini-budget, which was frankly disastrous. The Bank of England says it still intends to reduce the total gilt holdings by the £80 billion announced in August, but policymakers will review the pace of sales annually. British government bonds have a longer average maturity than those issued by the countries, so the Bank of England has to sell gilts to achieve the same pace of balance sheet reduction that other central banks would get by simply allowing their bonds to mature. And more broadly, QE, of course, was always intended to be temporary, and Governor Andrew Bailey has been keen to reverse some of the purchases, especially after the Bank of England gilt holdings doubled during the wave of QE purchases in the COVID-19 pandemic. At its peak in December 2021, the Bank of England owned roughly half of all conventional British government bonds in issue. The Bank of England does not intend to fully reverse QE because regulatory changes made since the 2008 financial crisis means banks do need to hold more cash than before, but it's not set up a long-term target for gilt holdings. Reversing QE may help to fight inflation to the extent it pushes up borrowing costs and gives the government, businesses and the public less money to spend on other things. But the Bank of England says raising interest rates is its main tool for controlling inflation because the impact is better understood than that of QT. And bond strategists have questioned how strong demand will be as gilt prices have slumped this year, and some investors suggest that the central bank will be wiser to postpone sales until 2023. City noted that long-dated gilt prices rallied relative to those for shorter-dated gilts after the Bank of England announced on October the 18th that it would exclude them from its purchases this year. The overall past effect of QE on the economy has been difficult to measure, and it's especially hard to separate the effect of actions from the Bank of England from spillovers from bond purchases by the Fed and the European Central Bank. In broad terms, QE pushed down borrowing costs for medium or longer term periods, slightly raised inflation, and probably led to somewhat lower unemployment and faster growth than otherwise. But it's really hard to know, frankly. The Bank of England also emphasised the need for QE to stabilise markets at the start of the COVID-19 pandemic. But critics say QE played a major role in pushing up house prices and stock markets for more than a decade, worsening inequality. The Bank of England has said that without QE, consumer price inflation would have undershot its 2% target during the 2010s, and that unemployment would have been much higher at points through the cycle. Now, over in New Zealand house prices suffered their first annual decline in more than 11 years in October, as surging home loan interest rates discouraged buyers. Prices fell 0.6% from a year earlier. That's the first year-on-year drop since June 2011, according to data from CoreLogic. Values fell for a seventh consecutive month, sliding 1.3% from September. Stretched affordability is constraining the ability and willingness of all buyers to get or extend a mortgage, said CoreLogic Head of Research Nick Goodall. This all leads to reduced demand and contributes to falling prices. The Reserve Bank has increased the official cash rate by 3.25 percentage points to 3.5% over the past year, and some economists forecast the benchmark could go as high as 5% or higher in 2023. The banks have lifted home loan interest rates to match the aggressive tightening cycle, and CoreLogic expects mortgage interest rates to continue to rise. Goodall says that the variable interest rate averaged 7.1% at the end of October, but at least one main bank uses an 8% assumption to test whether a customer can service a loan, and that test rate could rise to 8.5% if the OCR climbs even higher next year. Economists are predicting house prices will fall about 13% this year and decline further into 2023 with a peak-to-trough slump of around 18 to 20%. And Goodall says the impact for the Reserve Bank of New Zealand's aggressive rate increases on property values and the broader economy may give the central bank cause to rethink. For now, the impact has been manageable and limited, but with each OCR rate hike comes a heightened risk of a deeper and longer recession, and with it growing unemployment and financial stress, he said. And to add insult to injury, the latest unemployment statistics remained at 3.3% according to Statistics New Zealand, but frankly that's not the figure that got much attention. The big figure among the suite of the labour market figures released for the December quarter is an astonishing annual 8.6% rise in private sector hourly wages. Most economists had expected maybe a figure with a 7 in front of it, while the Reserve Bank itself had the highest forecast at 8.3%, but at 8.6%, it's completely blown everything out of the water and potentially has huge ramifications for interest rates. The Reserve Bank of New Zealand will next review the official cash rate, which is currently at 3.5%, of course, on November 23rd. General expectation is that it could raise the OCR by 75 basis points. And in fact, ANZ economists are still picking a 75 basis point rise. Finn Robinson and senior economist Miles Workman said despite the dramatic monetary policy tightening already delivered, we're getting further into wage price spiral territory. And with labour demand still miles ahead of supply, that's unlikely to change without further action from the Reserve Bank of New Zealand. They see the September quarter's underutilisation, employment, wage and CPI inflation data as tilting the odds further towards the second 75 basis point OCR hike that we've already penciled in for February, which will take the OCR to a peak of 5%. And New Zealand's central bank said that rising debt servicing costs and falling house prices will hit household spending and contribute to slower economic growth in the year ahead. Based on current mortgage rates, debt servicing is expected to rise to 20% of average household disposable income from 9% currently, the Reserve Bank said in its semi-annual financial stability report released on Wednesday. Negative equity and mortgage servicing arrears are not widespread at present, they said, but will grow if house prices continue to fall and as mortgages reprice to higher interest rates, it said. The downturn in the housing market will weigh on economic activity, and that rising household debt servicing costs and declining household wealth will limit consumption growth over the next year. So home loan interest rates are climbing as the Reserve Bank combats soaring inflation, with the official cash rate at a 7-year high, and policymakers tipped to increase it another 75 basis points to 4.25% later in the month. The Reserve Bank said the number of households in financial difficulty will grow as fixed-rate mortgages agreed to 3 years ago, when interest rates were at historic lows, start to reprice at significantly higher levels. Significantly higher unemployment will lead to further stresses among households and is the biggest risk to financial stability at present, the central bank said. But despite these challenges, New Zealand's financial system is well placed to support the economy, with bank capital and liquidity positions strong and profitability and asset quality high, it said. But the Reserve Bank of New Zealand expects a decline in new residential construction once existing development projects are completed, which will contribute to slowing economic activity. The outlook for residential development has deteriorated in recent months due to declining prices for existing houses, ongoing construction cost inflation, negative net migration, and rising interest rates, the bank said. A slowing in residential construction would weigh on broader economic activity and employment. So you can see that wherever you look, the ravages of inflation and the central bank's responses are having consequences. It's putting pressure on households, it's curtailing spending capacity, and of course the risk of recession builds, which is why I still believe that the markets are yet to fully price in these downside risks. But of course it'll take a bit of time for that to work through, and I still tend to think that the markets will be somewhat lower over the next few months relative to where they are now, and that interest rates will be somewhat higher. We have not got to the end of this cycle yet, and I think there is more grief and pain to come. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer.